Most people grow up believing that wealth comes mainly from hard work. And on the surface, that sounds reasonable. Work hard, earn more, save more, build a better life. But when you look at how money actually moves over long periods of time, a different pattern starts to appear. Wealth does not usually spread out evenly. It tends to gather. It gathers around ownership. It gathers around systems. And it gathers around capital that already has the ability to grow. A big reason for that is compounding. Compounding sounds simple, but its long-term effect is enormous. It means money can generate returns, and then those returns can start generating returns of their own. At first, the difference looks small. One person has some savings invested in assets. Another person is only relying on monthly income. In the beginning, the gap may not feel dramatic, but over time, it grows, and then it grows faster. That is the nature of compounding. It quietly turns small advantages into larger ones. But compounding alone is not the whole story. Ownership matters just as much. Most people earn through labor. They trade time, effort, and skill for income. That income can help them survive, support a family, and maybe even save a little, but it usually depends on continued work. If the work stops, the income often slows down too. Ownership works differently. When someone owns shares, property, a business, or other productive assets, they are not only earning from effort. They are connected to something that can keep creating value over time. That asset can rise in price. It can generate cash flow. It can benefit from demand, scale, and reinvestment. And that changes the speed of financial growth. Labor usually grows step by step. Ownership can grow on top of itself. That is why two people can work equally hard and still end up in very different financial positions years later. Then there is structural advantage. People who already have capital often gain access to better options. They can invest earlier. They can stay patient longer. They can recover more easily from setbacks. They can make decisions from a position of flexibility instead of pressure. Over time, that matters a lot. Because wealth is not only about how much money someone earns today, it is also about what that money is connected to, what it can access, and how long it has to grow. This is why wealth concentration often feels less like a random outcome and more like a system doing exactly what it was built to do. Capital grows most effectively when it is attached to ownership. Ownership creates more opportunity, and more opportunity creates the conditions for even more growth. So when we ask why wealth tends to concentrate over time, the answer is not just that some people make more money. It is that money behaves differently once it becomes capital. It can scale, it can compound, and it can keep moving through structures designed to multiply it. Once you see that, wealth stops looking completely accidental. You start to see the pattern behind it. So when we ask why wealth tends to concentrate over time, the answer is not just that some people make more money. It is that money behaves differently once it becomes capital. It can scale. It can compound. And it can keep moving through structures designed to multiply it. Once you see that, wealth stops looking completely accidental. You start to see the pattern behind it. And that naturally leads to a deeper question. If wealth grows most powerfully through ownership and capital, then what are the real limits of earning only through a salary? That is exactly what we will explore next.